$500 billion. One partnership announcement. Nvidia and 7 Wall Street firms just committed that figure to AI infrastructure. Every dollar of it has to come from somewhere, and the question this raises is one that shapes every boom in history. When a technology needs more capital than any single player can supply, how does the financial system actually move that money? Nvidia announced a partnership with 7 Wall Street financial institutions. The goal is to raise more than $500 billion of third-party capital. That capital would fund the build-out of AI infrastructure, data centers, chips, the physical backbone of artificial intelligence at scale. The word third party is doing a lot of work in that sentence. Nvidia isn't writing the checks itself, it's organizing the machinery that finds, structures, and channels money from investors who have it toward projects that need it. This is a financial architecture story as much as a technology story, and understanding how that architecture works tells you something far more useful than any single headline. It tells you how capital moves when a technology is too big for any one balance sheet. Every few decades, a technology arrives that needs more money than existing institutions can easily supply. Railroads in the 19th century, electricity grids in the early 20th, interstate highways, broadband. Each of those build-outs required a financial layer on top of the technology itself, a system for pulling money from thousands of different sources and directing it toward thousands of different projects. The people who built that financial layer often captured as much value as the people who built the technology. AI infrastructure is the current version of this challenge. A single data center capable of training frontier AI models can cost hundreds of millions of dollars. Multiply that across a country or a continent, and you're talking about numbers that dwarf what most technology companies hold on their balance sheets. No single firm, not even the largest, can fund this alone. So the question becomes structural. How do you build a financial system around a technology build-out? The answer is a mechanism called capital formation at scale, and it works in a way most people have never been shown. Think about how a music festival gets funded. One promoter doesn't pay for everything out of pocket. They sign artists to create the draw. They sell tickets in advance to prove demand. They bring in sponsors who want access to the crowd. They negotiate with venues, caterers, and equipment companies, some of whom take equity in the event in exchange for lower upfront fees. By the time the festival happens, dozens of different financial relationships have been structured so that risk is spread, returns are promised to the right parties, and the promoter sits at the center of a web they designed. Capital formation for major infrastructure works exactly the same way. A company like Nvidia sits at the center. It has something everyone wants: access to the technology, the relationships, the credibility. It uses that position not to write checks, but to convene. It brings in financial institutions who each have a different pool of money: pension funds, sovereign wealth funds, private credit, project finance, insurance capital. Each pool has different risk tolerance and different return expectations. The convener's job is to match those pools to the right parts of the project stack. Some investors want the safest, slowest returns. They get first claim on revenue from infrastructure that already has paying customers. Some want higher risk for higher reward. They get equity stakes in newer, unproven projects. The financial institutions in the middle structure those deals, earn fees, and take a slice of every transaction they facilitate. The convener, the festival promoter, earns something more valuable than any single fee. It earns a position at the center of an ecosystem it helped create. That position is durable. Individual deals come and go, but the ecosystem keeps generating transactions, and the convener keeps sitting at the middle of them. This is why the partnership model is so powerful. It doesn't just raise money once. It builds a machine that raises money repeatedly. So why does any of this touch your life? Because infrastructure capital formation doesn't stay abstract for long. It lands on things you can see and pay for. When the financial machinery around a technology works well, build-out accelerates. More data centers get built. More power capacity comes online. The cost of computing falls. That falling cost eventually shows up in the price of every product or service that uses computing, which at this point is nearly everything. When the machinery works badly, when capital can't find its way to projects fast enough, or when it gets misallocated into the wrong bets, build-out stalls. Shortages develop. The cost of computing rises instead of falling. Businesses that depend on AI capability face higher bills. Those higher bills get passed somewhere. They land on a software subscription, a logistics cost, a price at checkout. The stakes are not just for investors watching a stock. They're for anyone whose life runs on infrastructure, which is everyone. Capital formation at this scale also reshapes who holds power in an economy. The financial institutions that sit inside these partnerships gain privileged access to deal flow, information, and relationships that outside investors don't see. Over time, that access compounds. The firms at the center of major capital formation events in the past, the banks that financed the railroads, the underwriters who built the electricity grids, became institutions that shaped economic life for generations. The firms that sit inside this kind of partnership are positioning for the same kind of durability. So back to the question the Nvidia announcement raised. When a technology needs more capital than any single player can supply, how does the financial system actually move that money? Now you have the answer. It moves through a convening mechanism, a central player with credibility and access who builds a web of financial relationships, matches different pools of capital to different layers of risk, and earns a structural position at the center of an ecosystem in exchange. The technology company provides the draw. The financial institutions provide the pipes. The capital providers provide the fuel. And the whole system is designed to keep running long after the announcement that launched it. What Nvidia announced is not a one-time fundraise. It's the construction of a capital formation machine. That machine, if it works, will keep directing money into AI infrastructure for years. The announcement is the news peg. The mechanism is the story. And the mechanism is as old as the first time humans needed to build something too big for any one person to pay for. The form changes. Railroads become fiber optic cables become GPU clusters. The structure underneath doesn't. Whoever controls the center of the web controls the economics of the build-out. That's the thing worth understanding. Not the number, not the partnership, the position. If this reframed how you think about infrastructure capital, share it with someone who's watching the AI build-out and wondering where the money actually comes from. Subscribe for more mechanisms behind the headlines, explained the way they actually work.